individual stocks which are reacting to the news flow. But let's talk about the year ahead, and who better than Nilesh Shah, MD at Kotak AMC, to throw light on that. Nilesh, hi, good morning. Great to have you on the show. Nilesh, I'm just looking at how 2025 has been, and forget what the Nifty and the small caps have done. I can't get over how silver and gold have done. How does an equity market investor make their peace with the kind of parabolic move on gold and silver?
Well, the equity market investor has to follow the dharma of asset allocation. You have to divide your portfolio between real estate, debt, equity, as well as precious metal. An investor has to keep an open mind and follow the dharma of asset allocation.
But Nilesh, the question is, given this kind of a move that we've seen on both gold and silver vis-a-vis what Nifty, and I'll come to small caps again in a bit. But do you sense that this multi-asset allocation is going to work in 2026 too? Or do you now perhaps need to take a larger exposure to equities? Do you sense that there could be a catch-up in how Nifty and gold, or rather silver and gold, have performed vis-a-vis what the equity markets have done?
Undoubtedly, the kind of parabolic run we have seen in precious metal is unlikely to be repeated in 2026. However, the outlook on both gold and silver continues to remain positive because of central bank buying and industrial demand for silver, especially from electric vehicle. Every month, one will have to look at World Gold Council report to see what is the activity of central banks. As long as they are buying and up to a price at which they are willing to buy, gold prices will remain supported. Silver being an industrial commodity, one will have to do a little bit more work. You'll have to find, is there an alternative solution emerging for silver as industrial commodity do get replaced by alternate commodity if prices go beyond a reasonable limit. So outlook on gold and silver both remains positive, subject to the central bank buying and intervention.
That's the take on precious metals. Nilesh, hi, morning. Give us your sense on where do you see equity headed into the next year? Now, given the kind of volatility we've seen, the favor has largely been towards the large caps this time around. And mid caps and small caps, they've slightly underperformed the overall benchmark. What is your take on what the equity move could be next year, and where could the bias lie?
The gap between large, small and mid-cap performance in CY25 was very wide. We expect that to narrow down significantly in CY26. The valuation re-rating of Indian market looks difficult. We are already at premium to historical averages across large, mid and small, and also at premium to our historical average to peer group. Effectively, return in CY26 and beyond is likely to come from the earnings growth. Thanks to all the reforms unleashed by the government, the outlook on earnings growth is now double-digit for CY26 FY27, and that kind of return should be expected across large, mid and small. Since the earnings growth in mid-cap is better and valuations are slightly above fair value, we think mid-caps probably will outperform in CY26 or FY27, followed by large cap, and small cap, as they continue to trade at a significant premium to historical average, may underperform CY26 FY27.
Interesting you say that, Nilesh. Nilesh, do you think that the texture of investing as has played out in the last 3 months is going to be more bottom-up stories? And I'm talking sector-specific moves here.
Undoubtedly, Aisha, within sector, there will be winners and losers. We have seen how deals can shape valuation of a company. We have seen how technology adoption can shape fortune of a company. And we have also seen how access to capital can change the game. If we come to the new age sector, clearly there are two requirements for being winner. One, access to unlimited capital of your own or of your sponsor. And second, a path to profitability. So there will be bottom-up stories playing out in CY26 as well as FY27. And one will have to keep on evaluating opportunities with open mind.
Nilesh, the one bottom-up story which is currently under play is IT. How much of it is just a catch-up because of its stark underperformance all through the year? Or is it just because of the rupee tailwind? Or do you genuinely feel that, the fundamentals are turning on ground when it comes to IT services?
So rupee and IT sector has no connection. When rupee was 31 rupees and 37 paisa to a dollar, large cap IT companies' profit margin was between 20 to 25%. When rupee is 89 rupees to a dollar, margin remains the same. Ideally, with rupee depreciation, those margins should have expanded. So a quarter here or there, rupee does have impact on IT services companies' profitability. But over a longer period of time, that is not a material factor. The buyers of those services exactly know what is the value of rupee and factor that into the prices. Now, coming to the more fundamental question, is growth going to return into IT sector? A lot of it is linked to US economic growth, US banking and financial services, investment in technology. Today, we are seeing that a lot of investment is going into, let's say, hardware of AI, like the GPUs. There is limited budget for the software of AI where Indian companies can play a role. But as the parabolic curve on hardware investment starts flattening, there will be opportunity for investment in software. I was reading one of the tweet by someone which said that now robotics will take off, and they mentioned that hardware was never an issue for robotics. It was always the software. With LLMs coming into play, we are in a position to train robots in multiple things. So a time for software will come. That is what is being factored into the Indian IT services prospects right now. It's kind of buying before the news. Let's hope and pray that those news do materializes.
Okay, that's interesting. That's the outlook on IT. Nilesh, 2025 has largely been a year of PSU banks, metals, and autos. Heading into 2026, are you penciling in some sector rotation? Could the story or could the narrative tilt towards names that have not done all that well, like pharma and real estate, or do you believe that there are more growth levers present for some of these sectors that could continue in the near term?
Undoubtedly, within healthcare, if you see, hospitals have done extremely well. Domestic focused pharma company or CDMO focused pharma companies have also done well. The companies which haven't done well were more related to generic exporters to US. We believe there will be rotation in pharma. Real estate, we are not that very bullish. Real estate prices have gone up. Affordability, while on paper looks on the higher side, in reality, we are seeing some amount of demand traction. Some of the numbers, for example, in Mumbai market, which comes about sales, that's actually redevelopment sales getting counted as fresh sales. So there's not much demand at this prices in reality, though it may look there on paper. So real estate, we continue to remain negative. On the public sector bank, we still think there is room for valuation to expand. The earnings growth will continue to expand as NIMs kind of bottom out over next 1 or 2 quarters. So PSU bank, there will be bottom up stories. In pharma sector, there will be rotation. And in real estate, one has to be cautious.
Interesting you say that. Nilesh, the one defining factor, perhaps why, or rather what kept markets a little at bay, was also the kind of gush of liquidity into IPOs. And looking at the pipeline so far for 2026, it seems like it's going to be a replica of what played out in 2025. How do you think this phenomena is going to get digested into the secondary markets?
So in a way, IPO supply has ensured that the liquidity which was there with investors continued to get invested at reasonable valuation or reasonable prices. We believe IPO investment is no different from your existing investment. You have to evaluate your company properly, you have to evaluate the management properly, and then take a call. Many of the IPO do get very large retail participation, and most of them are kind of flip-flop investors. That doesn't really build IPO market in a significant manner. But for us, IPO investment is as good as our existing investment. We have no option but to evaluate the bottom-up story and invest based on where we have valuation comfort.
Okay, and Nilesh, the market this year has had its own fair share of headwinds in terms of tariffs, in terms of the FII selling exodus that we've seen. At present, do you think there is any downside risk in the market, that the market is underpricing as of now? Anything that we should be cautious heading into next year? Perhaps the lack of participation when it comes to AI, could those be some factors to watch out for?
So you should never say never. Anything can happen. The market as of today would have discounted all the known news or all the known events. For example, geopolitical tension, the tariff levy on India, which is completely unjust and unreasonable, as we are not the largest importer of Russian energy. European Union and China begs that attention, begs that credit, but still we are levied unreasonable tariff. But could there be more events, more news which could impact Indian market? Undoubtedly, yes. We'll have to be always watchful as to what kind of events can happen and impact our economic growth. At the end of the day, do remember that when investors are investing, they are discounting future. It's not just 1 quarter, 1 year, 2 year. It's probably 10 year, 15 year, 20 year. So events, when they happen, they may look very big in the short term, but their overall impact on the long-term value will be minimal.
Quite interesting. So Nilesh, before we let you go, the one piece of advice for investors as we venture into the new year?
I'll simply say follow the dharma of asset allocation. Invest across debt, equity, real estate, and precious metal, and be watchful about your portfolio as events can change views.
Interesting. All in equal quantum though, Nilesh, or a higher allocation in any of the asset classes?
So the best way to evaluate a fund manager is not based on his stock only, but also on his own asset allocation. The Kotak Multi-Asset Allocation Fund that today has about 23% allocation to gold and silver against maximum permissible 25%. About 57.5% is in equity against maximum permissible 80%, and rest is in fixed income. So our transparency is visible on our fact sheet every 15th day.
Okay, we'll keep tracking that. But Nilesh, great to have you on the show, and here's wishing you and your entire team at Kotak a very happy and prosperous new year from all of us.
Thank you, Aisha, and wish viewers of ET Now a very happy and prosperous 2026.
Thank you.